Under Act 60, dividends are considered tax-free. What dividends? From where? What's on offer? And exactly how does that work? Let's find out. So, to understand exactly how this works, we need to go back to the actual statutes and read the law. So, for background, let's go over what applies. 1. Dividends are sourced to the location of the issuer under IRC Section 861A2. 2. Puerto Rico source income is excluded from federal taxation via 26 CFR Section 933. 3. Puerto Rico source income from interest, dividends, and capital gains are tax exempt under Act 60. 4. Therefore, dividends from companies with headquarters located in Puerto Rico are 100% tax exempt under Act 60. Doing an exhaustive search of the U.S. markets, we see that there are exactly 4 stocks listed that meet this criteria: Banco Popular, First Bank, Oriental Financial Group, and EVTC. The highest dividend yield amongst them is First Bank at 3.88%. Having a look at Yahoo Finance here, we can see the long-term history of Banco Popular shows a run up along with the lead up to the global financial crisis, and then a dramatic drawdown and slow recovery since then. It did not really bounce back like some other stocks, and the same pattern can be seen in First Bank Corp. Oriental Financial Group seems to have held up a little better and has just been putting in slow, volatile growth over the whole period. And EVTC is very recently issued compared to the other stocks, only coming out in 2013. This chart shows the broad index, the 4 stocks, and their yield-weighted composite in white, along with the drawdowns for that composite and the broad index. We can see that generally all of these stocks and their composite are correlated with the market, but with much larger drawdowns. Definitely here in green here, we can see that the broad index draws down, maybe maximum something like 35%, whereas the composite draws down something like 60%, which is quite a lot. Looking closer at these relationships, we can make the following observations. 1. Dividends from these stocks are considered Puerto Rico source, therefore they are not taxed to the IRS, and with Act 60 are tax-free. 2. Yield weighting results in some diversification without reducing the composite yield that much. However, there are only 4 such stocks, and all are subject to the same environmental risks and externalities. 3. These stocks are highly correlated to the broad market index and have shown poor recovery from the 2008 financial crisis. 4. Drawdowns are much worse than the broad index at 60%. 5. Puerto Rico real estate has a higher yield and is uncorrelated. 6. Amount of tax-free dividend is still less than some taxed options, BDC, boat, etc., with the tax, for less drawdown risk. So diversification into liquid, low-maintenance investments is still no justification. In conclusion, investing into these stocks just to avoid paying taxes is an inferior investment strategy that is surpassed by real estate investment or investment into tax dividend paying equities with better yield to drawdown mechanics. Avenues of further inquiry include 1. What other investments provide the best yield to drawdown mechanic, even considering taxes? And 2. Real estate in Puerto Rico. Not financial advice. Do your own research.